Working capital, also known as net working capital, is the difference between a company's current assets and current liabilities. The main components of working capital are usually cash, accounts receivable, inventory, and accounts payable. Working capital is also affected by short-term investments, short-term borrowings, and other current assets and current liabilities. But cash, accounts receivable, inventory, and accounts payable are usually the most prominent accounts and thus the primary focus when it comes to working capital optimization. So why do companies have working capital? Well, it's a part of normal business operations. All companies need cash, a current asset, to pay employees, income taxes, utility bills, current liabilities. But there are other ways that working capital arises. For example, a retailer might purchase inventory for cash today, but not be able to sell that inventory and collect cash from the customer for 40 days. The retailer would thus have cash tied up in inventory and accounts receivable, both current assets, for 40 days. Working capital requirements vary by industry. Discount retailers typically don't have a high balance of accounts receivable because most of their sales are cash sales. However, they do have a lot of inventory. Service providers don't have any inventory at all, but they might have a lot of accounts receivable. Working capital requirements can also vary across companies in the same industry. For example, if we have two discount retailers that are identical in every way, except for the fact that one of the retailers sells its inventory a lot faster than the other retailer, the retailer that sells its inventory more quickly will require less working capital. Working capital requirements are affected by the length of the company's cash conversion cycle. The cash conversion cycle is the number of days between when the company pays cash to its suppliers and receives cash from its customers. For example, assume that a company acquires inventory on credit today and promises to pay its supplier in 15 days. The company will sell its inventory in 35 days and collect cash from the customer 30 days after that. Thus, the company needs to pay cash to its supplier in 15 days, but it won't receive cash from a customer for 65 days. The cash conversion cycle is thus 50 days. Why does this matter? Because the longer the cash conversion cycle, the more working capital will be required. This means cash will be tied up in inventory and accounts receivable instead of earning a return. This also means the company might have to increase its reliance on short-term borrowing to finance its inventory and receivables. By selling inventory faster, collecting receivables more quickly, or paying suppliers more slowly, the company can optimize its working capital, reduce the length of its cash conversion cycle, and increase the value of the firm. Working capital optimization thus involves inventory management, receivables management, payables management, and cash management. And you'll learn more about each of these components of working capital optimization in the videos to come. If you'd like to receive the PDF guides I've created on each of these topics, you can sign up for my email list using the link in the description section below. You can also access the PDF guides immediately by becoming a supporter on Patreon.